Welcome back to Conversation to Close. I'm Sean, and today we're diving into one of the most flexible financing strategies in real estate, seller financing. This strategy allows you to buy a property without going through a traditional bank loan. Instead, the seller becomes the lender, and you make payments directly to them over time. If you're looking for creative ways to structure deals, seller financing is a must-know strategy. Let's break down how it works, the key steps, and the pros and cons. First, how does seller financing work? In a seller financing arrangement, the seller acts as the bank, providing you with a loan to purchase the property. You'll negotiate terms like the down payment, interest rate, and payment schedule directly with the seller. In most cases, you'll sign a promissory note outlining these terms, and the seller may hold a deed of trust or mortgage until the loan is fully repaid. This arrangement allows both parties to customize the terms in ways that benefit them. Now, let's go over the key steps to successfully structure a seller financing deal. Step one is negotiation. Discuss the down payment, interest rate, and loan term with the seller. A common setup includes a modest down payment, an interest rate slightly higher than a traditional loan, and an amortization schedule that works for both parties. Step two is documentation. You'll need a promissory note that specifies the loan terms, and in some cases, a deed of trust or mortgage that secures the seller's interest in the property. Make sure to involve a real estate attorney to ensure everything is legally sound. Step three is making payments. Just like with a traditional loan, it's critical to make payments on time to maintain a good relationship with the seller and protect your investment. Let's talk about the pros and cons of seller financing. On the plus side, seller financing offers incredible flexibility. Because you're working directly with the seller, you can often negotiate terms that are more favorable than what a bank would offer. This is particularly useful if you have limited credit or want to avoid the hassle of traditional loan approval. Additionally, seller financing can close faster since you're bypassing the bank entirely. On the downside, sellers may charge higher interest rates than a bank, and if you default on the loan, you risk losing the property and any equity you've built. So, when is seller financing the best option? It's ideal when the seller owns the property free and clear and is open to receiving steady monthly income rather than a lump sum payout. It's also a great strategy if you want to avoid the strict credit requirements and lengthy approval process of traditional lenders. And there you have it, the basics of seller financing. This creative strategy is a game changer for investors looking to build their portfolios without relying on banks. Thanks for tuning in to Conversation to Close. If you found this episode helpful, don't forget to like, subscribe, and hit that notification bell so you never miss an episode. I'll see you next time, where we'll dive into another powerful real estate strategy. Until then, stay creative and keep closing those deals. Take care.